Good morning. My name is Craig Bassinger, and I'm the Chief Investment Officer at Richardson GMP. And along with a couple of strategy and election impact reports that we published this week, we thought we'd provide a bit of a presentation format as well. So I'll jump into it, and obviously our title is Pandemic Polls and Positioning. So let's get started. It is the morning of November 5th on Thursday. So, talk a little bit about markets. We'll keep that pretty brief. Spend a little bit more time on the election and how the market has reacted to the election. A little bit on the pandemic, a little bit on the economy, and then also more on how the markets and both the economy have been diverging this year. So the markets, obviously this year has had everything. We've had a full-on bear market, fastest in history, fastest recovery, clearly driven by the pandemic, unprecedented stimulus in the trillions of dollars globally. And we still have 2 months left of this year. This year's already been pretty much jam-packed, filled with market-moving events, and it's not over. So we've got an election that the results are not final. They're getting closer as the counts continue. It does appear like there will be some gridlock. It also does appear that there will be some recounts and some bit of a contested election. And the markets have responded extremely positively to these results, which may sound a little absurd, but we'll touch on that and what's sort of driving that. It is a bit ominous. We did have a bit of a double top in Canada and the US. You can see on the chart on the left-hand side, that's TSX and the S&P 500. But as our technician expert also points out, we also had a double bottom, which is encouraging. So I think from a technical perspective, it's anybody's guess. Yields had been trending higher heading into the election and then abruptly reversed course following the election results, even though the results are not finalized at this point in time. So clearly a lot of things going on in the market. And, starting on the election, and this has obviously been the biggest move this week, there's a few things to sort of take away from this. One, the most likely outcome at this point in time, and again, this can change, is a Biden win, a Republican-controlled Senate, and the Democrats controlling the House, albeit a little bit less controlled than they had before. But the fact is, the volatility isn't going to go away the day after the election or even the second day after the election. It's going to continue. This is what the futures or the volatility indices were pricing into the options market heading into this. An extended period of volatility, and a lot of that had to do with the fact that we didn't know if there would be civil unrest, if the election is contested, how long that would take, what it would mean. I mean, there were just so many different things that could go on, and a lot of those haven't happened yet, and which is an encouraging sign. And I think that's one of the reasons the markets have reacted positively. But there's a few others as well. I would point out the polls got this one way wrong once again. There was even a better 50-50 chance of a blue wave with Democrats controlling everything. This election was much closer than I think the polls had indicated. And I think a lot of the commentators are saying that the pollsters have to really revamp how they do things because, they've been getting them wrong for a few sessions now. So what does it look like under the current most likely scenario of what's going on? And again, our huge caveat, this could change pretty abruptly, but if it is a Biden win and the Republicans control the Senate and the Democrats control the House, what does that actually mean? So normally a Biden win would be higher corporate taxes, which would probably be somewhat negative for markets. It's not a huge amount. I'll be honest. I mean, corporate taxes impact company valuations to a degree, but not nearly as much as you might think. If a company's earnings go up by 10% because of a tax cut, the market doesn't put a whole bunch of value on that because it's a regulated change. If earnings go up 10% because they're selling more widgets, that's the kind of growth markets like. So tax cuts, tax hikes, either way has an impact, but it's not huge. And it'll probably be even less given the Senate controlled by the Republicans. And that'll probably mute how much of the Trump tax cuts Biden could potentially try and roll back. Then we get to stimulus, and this one gets tricky. So, if it was a blue wave and the Democrats controlled everything, I mean, some of the estimates had, even $3 trillion of stimulus. That's probably not the case now because, we're now looking at an environment where the senators blocked the stimulus before the election, even knowing that their seats would be somewhat in jeopardy by doing so, and they still won, which means that they're probably even more empowered now to sort of dig in their heels on how much stimulus they would allow the administration to pump into the economy. So from a stimulus perspective, short-term negative, that has a GDP impact, that has an economic recovery pace impact, which is negative in the near term. There's no question. The markets and the economy do like stimulus. And that's why we had such a massive reversal in a lot of the value stocks and more economically sensitive stocks. Even yesterday, with the market up 2%, we had value stocks that were barely up. And those are the more economically sensitive ones. And a lot of that had to do with likely less stimulus. That means less growth. That pushed bond yields lower as well. But that's the short-term impact. Long-term, who really knows? And that's the tricky part. All this stimulus is certainly good for the economy today, but there is a reckoning to a degree. This is debt that's being accumulated, whether it's on the Fed balance sheet or in private hands. It is building up, and the fact is that will have an impact later on. Trade tensions. This is likely a positive. There's no question the Trump administration was very combative when it came to trade, not just with China, but a lot of other countries, including ours, Canada. Biden will be somewhat tough on trade as well, but probably not as disruptive. And again, the markets like certainty. The markets do not like not knowing if there's going to be tariffs, of how much they're going to be, when they're going to be implemented, when they're going to be taken down. Companies can't make decisions in that kind of environment about their supply chains and customers and pricing. So less trade tension, certainly positive for the market. So good short term. Long term, hard to say. Long term, because, well, we don't necessarily agree with the approach that Trump took on trade. We do somewhat agree with something has to be done in this area because it has become a relatively unfair environment on the trade side. So don't agree with how they did it, but certainly do agree with the objective of doing it. So if we do get less trade tension, does that mean we're actually going to hurt ourselves longer term? Hard to say. It would be nice to have a good old-fashioned president. We'll leave that where it sits. Increased healthcare spending, most likely. Less drug reform, again, with the Senate being controlled by the GOP than people were expecting if it was more of a sort of blue sweep. The Green Deal will probably still go forward, but probably not as big, given sort of a gridlock type U.S. administration. And same with infrastructure spending. So, a lot of those are, this is gridlock. It does look like gridlock. That's what the U.S. is going to have. And that, you normally hear that and you say, well, that's unfortunate. That's not good. But the markets think a little bit differently. So gridlock means lower bond yields, less economic growth, which is kind of negative longer term, but good for equity valuation short term, especially growth stocks. Well, that's what we saw quite a bit of yesterday and seeing it a little bit more today. The other aspect is gridlock means you can't make big changes. And don't get me wrong, I think there are some big changes. We think there's a lot of big changes that need to be made, whether it's climate, whether it's income disparity, whether it's healthcare in the U.S. I think these are things that need to be done, and there are long-term things that need to be done. But they're not going to be, it's going to be a lot harder to get any of them done with gridlock. So that's bad probably longer term, but good short term, because in the short term, what it means is there's no change. And no change is a very positive thing when it comes to markets. Markets love no change. Contested election, this one's interesting because a lot of people have been talking about a contested election, and it feels like the market was expecting a contested election. The question then becomes, if this does become a contested election, what it looks like, how long it goes on for, how long it drags on for, because our belief is the market was expecting a contested election, and it looks fine so far. And even if it is a bit contested, that's fine too. But if it drags out, till the end of November and into December, will the market still have that view? That's when things could change. But again, who knows how that's going to work out. Again, the market had a pretty dire expectation going into this. And I think that's one of the reasons that the markets have been reacting pretty positively. The other aspect is the election's behind us now. Like, I don't know how many people I've talked to who, were harping on the election, the election, the election. It's this sort of big thing, unknown, on the horizon. It's a bit around the corner, and resulted in people sort of not doing anything, holding off. And now that it's done, even though it's not completely done or concluded, it is behind us. We do know more now than we knew before. And given the fact that the market dislikes uncertainty, likes to know things, we know more now than we did 3 days ago. But while election uncertainty will probably continue to cause short-term volatility, it's going to get back to the pandemic and the economy in the coming months. And I think that'll probably start to drive markets a little bit more. Touch on this very briefly. Pandemic, this third wave is bigger than obviously any of the previous waves. And worth noting, it is very widespread. It's not just a handful of countries. If you look at sort of, this is active cases in the bottom left here, if you look at that second wave, that was, driven mainly by the US, in Brazil, and in India. But this third wave that we're in now, obviously much bigger, as you can see, but it's very widespread. It's everywhere. And, the market still pretty immune to this, still pretty much ignoring the pandemic as it did before. But we did see some wobbles a few weeks ago where the market started to react to case counts again. Not sure if that's going to come back, but if these numbers keep going at the pace they are, I think it probably certainly will. Still, mortality rate has come down, which is quite encouraging. And the big questions, we've learned a lot from this, and the more we interact, the more this virus spreads, and that's pretty straightforward. Of course, everybody keeps talking about the vaccine, and we've been doing a bit of a thought experiment along this, and there will be vaccines, there's no question. Most of the forecasts, have them becoming more widely available in Q2 of next year. But here's a question for you. If you could put a vaccine in your arm and it had a 70% effective or efficacy rate, would you get on an airplane? And that's an important question because, all of us would answer that somewhat differently. Some people will, some people won't, but you have to think in the aggregate of what everybody's going to do. The question is 70% effective enough to make us feel safe, becoming more economically active? That's the big question. Now, we do believe the market will look forward and the market will not wait until this is widely available. Vaccine's coming, it's in manufacturing, it looks like people are going to adopt it and start behaving more normally. Market will react much quicker, and that's, I think, when we'll start to see that sort of rotation out of growth and into value. Not yet, though. It's clearly we're not there. And this chart on the bottom is, the question is, who wants to go on a plane ride? This is the number of people going through security checkpoints in America on a daily basis. You can see it's recovered decently in the summer, sort of plateaued, and it has been rolling over with the higher case counts. Again, this pandemic, many people thought it was going to be a bit of a sprint, and it certainly has turned into a marathon. So on the economy, again, very different. This is a very different recession. We had, we've stopped a big swath of the global economy to fight a pandemic to various degrees. And we've had, a big contraction in GDP and a big rebound. Now, I'm not going to quote the GDP headline numbers with the minus 30% and plus 33% is their annualized numbers, and they're very distorted when there's big swings. So instead, this chart on the right actually just shows you US GDP in trillions. And as you can see, it was almost a $22 trillion economy, came down to below 20. Now it's above 21. It's clearly good recovery. Question becomes, where do we go from here? We've got that short-term V. Does it become a capital V on the recovery side as well? And that's the big question, because things are slowing down. We're going to get more employment data tomorrow from, this is US non-farm payroll data, how many people are employed in America. Canada looks very similar, just divide by 10. But, they had 150 million people working, dropped down to 130, now back up to 140, which is pretty impressive. But you'll notice those bars, the size of those bars incrementally increasing, keeps getting smaller and smaller. It's getting harder to get people back to work and get different jobs reopening. So a lot of the jobs came back real fast, and then it's getting harder and harder because there's also layoffs that are sort of countering that trend. And a lot of it has to do with sort of this divergence in the economy. Part of the economy is doing really well. There's no question. If you can work remotely, if you're in the durables business, homes, cars, RV sales, flying off the floor, flying off the lot, that would be where you buy RVs. But there's another cohort of the economy, and that's on the service side, and that's just still being crushed. And this chart on the right-hand side is 1 year change. So this is relative to pre-pandemic. as of now, as of the latest reading in September. And it shows you where people are spending money more than they were a year ago and much less. And this is obviously well into the pandemic period. So, we're all buying more sporting goods, motor vehicles, food and beverage. That's actual food and beverage, not from stores, grocery stores, health, general, gasoline, clothing, food services. Those are the parts being hurt. Problem is, North American economy employs a lot more people in those red bars than they do in those green ones. And that's why the employment is such a crucial number. And again, so we've got a big part of the economy still not working, still on life support from this stimulus, trying to sort of bridge that period from now until a vaccine or the pandemic starts to fade and we become more economically active in those areas. That's what the government's trying to do. That's why the stimulus is so important. And it'll be interesting how that goes forward. So again, very divergent economy. And the fact is, we're also we're also seeing that in the markets as well. The growth has dominated in this market. Growth companies are less economically sensitive, where value has really been hurt. Value companies tend to be more economically sensitive and more sensitive to what's going on in the economy. That's where the divergence is coming from. And you can really see it. So this is the TSX year to date, minus 5%. Not great, could be worse. But if you take out the top 5 names, and Shopify is the biggest contributor to that in that top 5, you're down to minus 12. S&P, same thing, up 4%. Take out the top 5, you're down 3%. This market is extremely skewed in certain areas, and it's a very bifurcated market. Breadth is extremely narrow. There's a few companies who are really, really winning, and they're big companies. But the fact is, the vast majority of companies are not, and that's a very divergent market and tough to invest in. If you're a dividend investor, God knows Canadians, we love our dividends. Our index is very dividend tilted. The fact is, we took the TSX companies and broke them into sort of 5 quintiles, 5 groups, based on how much they yield. That group on the left, those are the lowest yielding companies. On the right, the highest yielding companies. And then that's our average performance year to date. You can clearly see the pattern. Those companies yielding more are performing worse. And I think that's been a big frustration for a lot of investors, especially those focused on dividends. And again, that's because the higher yielding spaces is in areas like financials, real estate, telcos. These are more economically sensitive parts of the economy, and that's why they're getting hurt. And you can see it in the US as well, between growth and value. Growth has performed exceptionally well this year. Value has not. And, we saw a bit of a wobble in this relationship, in this sort of divergence between growth and value in the last couple of months. But as of the election results, it seems to be back in vogue, with growth outperforming value once again. This chart on the right is valuations. This is the price earnings multiple between those two indices, between S&P 500 growth and S&P 500 value. And the spread between them is so high right now. It's actually almost the 99th percentile over the last 20 years. That's how wide the spread is. Value is so expensive in this environment. Value is so cheap. This will reverse. Don't know when. Probably when the vaccine is on the horizon and the market starts to price that in. But again, it will reverse. Until it does, this trend is pretty resilient. From our perspective, we'll never pick tops. We're not good at it. We tend to be early on our trades. We tend to be sometimes months, even quarters early. And we've been leaning more international, which is more value tilted, a little bit less US. Even within the US, we've been tilting more towards equal weight instead of market cap weighted to get more of a broad value component. And this chart on the right just shows in our sort of asset allocation service how our equity style has changed over time. And that's the growth component at the bottom, the purple. They were all roughly equal weighted about a year ago between growth, core, and value. This is just the equity component. But we have certainly been trimming off the growth side, taking some money, taking some profits in those areas and redistributing into value. And we'll end it there. If you have any questions, please feel free to contact your advisor, and have a nice day, and thanks for listening.